Hey everyone, this is Jose Blasco. We are about to get started in 1 minute time. Let's have a quick sound check, if that's okay. A quick message on the chat box is what we normally do, isn't it? So that way I know that you hear me well. A quick hello is a nice way to start the session. And again, it confirms you hear me. So please go ahead and do that so we can start on time. We got 45 seconds to go. So let's use this time for the sound check. Thank you so much, guys. Thank you, Joe. This is appreciated. Thank you so much. Yeah, 25 seconds to go and we begin, everybody. Almost there. 10 seconds to go. We are almost ready to begin. Perfect. Top of the hour, everybody. Welcome to the session. My name is Jose Blasco. Today is Feb-16, 2022. This is Options with Options, which is, as the name suggests, it's where we get together and we look at the options markets and we get ready to find trades, execute trades, manage trades, learn options, utilize top, all of those things and beyond. How are you, Jeff? Good to see you. Before we get started the session, as always, I would like to highlight the disclaimer on the upper left side of the screen. Please read it carefully. This is indeed important information. I always point at the fact that the disclaimer is fairly short, so please read it completely because it is indeed important. And also, as we begin the session, a quick reminder of the agenda. So we're going to look at the market, understand the market environment, what's happening out there. From there, we'll look at trades that we have open and running. In some of those cases, it will be a short conversation. In some of those cases, if we get into trade management, there may be actions to be taken, things to be done. So we'll talk about it. And from there, we'll move into looking for other trades available in the market, so we can add more to the accounts, to the portfolios. Again, my assumption is always that whatever trade I plan, you're ready to take it. The reality is that depending on what else you have in your account, let's say for example you already got 20 trades where you're long, and I plan a long trade where maybe your portfolio risk rules don't allow you to take the trade. Again, since my intention here is to help as many of you as possible, again, every time I plan a trade, the assumption, if you wish, is that this is a valid trade to be taken, but always keep in mind that this has to do as well with what else you have in your account and what are your portfolio risk management rules. Okay. How are you, Christian? It's good to see you. Very good. So let's begin with the session. Also, a quick reminder of our question page. So for you to access the question page, you would just utilize tradewithufos.com/Jose. And when you come in here on the top, you can subscribe to the apps, you can subscribe to top, and the bottom part is where you would post your questions, you will get your answers. And I would certainly recommend to start searching for questions or searching for answers, because the questions you may have been already posted before, and the answers may be there waiting for you. If not, feel free to use the green button to ask questions, and of course express yourself, add screenshots of this, of your charts, anything else, so you can be properly understood and therefore get the answers that you need. Okay. Anyway, so we are looking at SPY. Let's begin our market analysis. So what do we have in front of us? Well, we are dealing with a confirmed climate to the downside. This particular climate has been running for 4 candles. Statistics suggest that 3 is a normal thing to happen. So we are surpassing the 1 standard deviation, if you wish. We are now stepping into less likely territory for the climate to continue progressing to the downside, even though I would like to point at the fact that the current max distance is only 0.78, where we call a move to the downside too far too fast when it reaches 110. So we have not reached 110. The furthest we went was 0.78. In other words, while the climate is lasting a bit more than what statistics suggest, it would not be fair to say that this climate is, crazy. It's an unsustainable market condition. It doesn't look like that. So certainly it could continue for a bit more, even though based on auto climate, we should have a change of climate sooner than later, based on statistics. Okay, I mean, for sure, sometimes statistics are not met. You can see here how a red climate was lasting way more than expected. But again, technically, theoretically, 3 is the number. Okay, so this is number 4 today, and therefore we should see a change of direction. It should happen sooner than later based on statistics. Now, in the prior week, I was talking about what a fight. Okay, right? So if you recall, during all those days, it's like the market was really not deciding which direction to move in. How are you, Mark? Just seeing your message there. And one of the reasons for that, and we saw it, is that when we looked at options data, everything was very equalized. Not only auto climate was very equalized, options data too. Well, guess what? Today, when looking at the 3-day average, okay, we can see that the implied volatility of the calls and the puts are again, one more time, exactly the same, 21.33. So again, lots of pressure, lots of fighting between the buyers and the sellers, where when we go a bit further out in time, we do see some differences. Okay, we do see some differences. Actually, the settings I have here are not correct. Let me adjust this. Yes, correct. Yeah, I was making some changes here, and I guess I never got it back to what I want. So let me remove the options volume map, and let me add it again, because I have my settings set as default. So that's going to be the easiest way to get it all back to normal. Yes, correct. Okay, so sorry for that. So yeah, so what I was saying is that notice how we are dealing with 1.4, 1.5, 1.1, 1.4. So it seems that if we are looking at the end of the month now, all the way to February 28th, on that expiration date, we get to see a bit more decision when it comes to what is being traded the most, the calls or the puts. And it seems that it's the puts. But short term, the number is fairly small, even though everything is gray color, meaning the puts are winning all the time. But it's not a very big number. So again, definitely this confirms the climate being down, and I would expect it continues down for a bit more. Why? Because again, the puts are winning, even though it's by just a little bit, and also because real time today, the gray line is above the blue. Implied volatility on the put side is greater than the call side, even though as an average is equal. Intraday or real time, it's not the case. The puts are winning, so that additional excess of puts, we could not only understand that there are more puts than calls being traded, but on top of that, they are being bought. That's why the implied volatility for those puts is higher. So what's building up from behind the scenes is a bearish sentiment, which again, based on the auto climate, should not last for that long. So it's not like the world is ending, even though, of course, there are always things happening in the world, fundamental reasons that maybe the cause for a crash or for a crazy rally. In this case, maybe we are all thinking about Ukraine and Russia and all those things. But technically speaking, I'm not that impressed by any piece of data. Even here, you can see that we are not reaching the average volume for the calls. We are not reaching the average volume for the puts. Here, we are not either. 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 So, long story short, just like last week, everything is quite equalized. Okay, there is a little bit of an extra bearish component this week compared to last week, but it's not like it's that dramatic. So that's what we have from an analysis of the S&P. When looking at the VIX, we're talking about 26% volatility, and that is a decent number. Okay, it's a pretty decent number, and in that sense, I would like to invite us all to explore later when I'm done with the trade reviews. I would certainly move into non-directional trading, and just like the last week, we were focusing on double calendars. So this week, I'm going to get back to focus on iron condors. Why? Because volatility went higher. And the market is still not very clearly decided from a directional point of view. So let's take advantage of volatility being high, using iron condor as a range-bound strategy, where we could work on trades that may move up or down, but within a certain range. Okay, so that's going to be my approach for today, given the market conditions. So back to SPY, I would love to get some comments from you guys on the chat box. I am now making the chat visible on the screen. So please go ahead and type what's your view of the markets? Do you agree? Do you disagree? Are you with me? Did you follow my explanation? Do you have any question? Do you need to repeat? It's all good. If it's all good, just type OK. But please go ahead and type it so I get a bit more of feedback from you guys, which is very, very appreciated before I begin the trade reviews. So I'll be waiting for that. I'll be watching for that. We had a little problem on the chat the other day, but today it seems that it's all working fine. So counting on you guys there to type your opinion about this market analysis. Now, from there, I'm going to start preparing to review the positions. Okay, so it seems that you guys are a little bit in the shy side. Not sure why. Or maybe, okay, here we go. Now I can get a message from Mark here. So what about longer term? Would one sell calls or bear call spreads? We could certainly do a little bit more longer term analysis of the market. We can certainly now move into a weekly time frame, for example. And if we were to look at a weekly time frame, and to be honest, the climate here is showing us confirmed, okay, 5 out of 2, okay. So the situation is similar in the sense that the climate has exceeded number 2. So we are dealing with number 5. So we've been 5 weeks going down, where statistics would suggest that 2 weeks is a normal thing to happen. More than that is not so normal. But at the same time, the speed at which we have been going down reached a maximum of 152, where 2 standard deviations of what we call too far too fast to the downside is 2.17. So certainly, that movement was aggressive. Okay, this move to the downside was, not a joke, but from a statistical point of view, not that crazy either. Okay, so again, based on auto climate, it is more likely for the market to come back higher than go lower. But again, since we haven't seen that much craziness from a max distance points of view, I would not be surprised that maybe before the climate becomes blue, since we already surpassed number 2, which is the normal thing to happen, and therefore we are in a less likely territory, but at the same time, a less likely territory, which is proving itself to be less standard. So I would not be surprised that for another week or two, maybe we see the market going down, going up, going down, a little bit of a fight until finally we have a change of climate to go back to blue. Okay, so a good action to be taken if you have certain positions, okay, and you want to protect yourself could be, and I'm talking about let's pretend you are long shares, okay, so you own stocks, you own ETFs, something like that. So certainly, if you are long shares at whatever price level, whatever market that is. So something you could do to protect yourself a bit is sell calls. And this is, to be honest, very incorrect. If I say to protect, selling calls is not protecting anything. It's just giving you extra premium that, if the stock remains range bound, at least that premium is yours. So you make money on premium collection instead of stock movement, right? But at the same time, it does create a little tiny bit of a protection, even though it's a really wrong word to use, because let's say you collect $2 of credit, so if that stock drops by 2, so you are still breaking even because the $2 you collected protect against the $2 loss. Of course, if the stock keeps falling all the way, then there is no such a thing as a protection. You're going to lose, and you can lose a lot. So selling a call could be an action to be taken to protect shares. Another action you could do is to buy puts thanks to the call premium collected. This is what is being known as a collar. Okay, so you own shares, you sell a call, and now you use whatever premium you collected to buy a put below price, and that's what is known as you are collaring your stock, and therefore the risk profile is equivalent to a bull call spread, which is sell a call and buy a call below. Okay, in other words, if you were to look at the risk profile, it looks something like that. So the most you can lose is limited. Then if the stock goes higher, you make money, but then if you go above the call, your most you can make is also limited. So it's exactly the same as a bull call spread. But again, if you own shares, that would be one way to get a bit of protection if you are concerned about this to happen. And you want to stay on the trade because you are collecting dividends or something like that, okay? So again, giving you some choices there. Bear call spreads would be a technique to be aggressively profiting from drops, okay? So a bear call spread, Mark, would imply that You don't have anything. You're just throwing bear call spreads out there, and then for sure you can do that. Nothing wrong with it. But again, the current market environment, I would say, is not ideal for that, because both on the weekly time frame as well as on the daily, we are reaching uh, candle number 5 on the down climate. On the daily was candle number 4, where statistics suggest is 3. So in other words, we are dealing with climates which are more likely going to reverse to the upside than to the downside. So doing bear call spreads, okay, maybe the recipe to collect good premium, because volatility is 26 now, right? But at the same time, then you have the stock move against you, and then you lose on the trade. So again, my approach would be iron condors, okay, where you get double the amount of premium. I mean, double is a simplification, because the call side and the put side won't pay exactly the same, but it's kind of like you get double what you would get in a bear call spread, and in a climate that is getting tired, where that climate may then go ahead and reverse. So that may be a better choice. Okay, so that would be my comment to you, Mark, on your question. Very very good thoughts. Um, yeah, Mark, we still haven't had a major correction since 2009. So, in one hand, you may say that's crazy, but I guess we all agree that last year we could have said it's crazy. The year before we could have said it's crazy. The year before we could have said it's crazy, because the market, I mean, if you think about fundamentals on the U.S. economy in this case, and while may not be nice to hear, but the fundamentals are really not good for many years. But the market kept going, right? So again, the nature of market movement, while fundamentals have a very big role to play, the natures of market movements is way beyond, with electronic trading, electronic markets. So the markets are, there are forces in the market that move price which are way beyond what common sense would suggest. Okay, so in this case, you don't want to be biased and expect a correction this year just because that's it. It's been enough. Now it's the year for the correction. Well, that bias could be dangerous, because you may be proven wrong all the way for 5 more years, where you could also be proven right, but you could have been proven right 3 years ago, 5 years ago too. So again, instead of having a belief or having a bet, let's rely on technical data that is given to us on the screen, so we can have objective mechanical decisions instead of decisions that may be influenced by what you would want to see from a trader point of view, or what you may be fearing, or whatever that is. Okay, so let's put trading psychology on the side by relying on data instead of whatever we may feel may be right or wrong. Okay, but which is not data. Very good. So next comment there from Christian. I am not trading in a market where fundamentals can kill technicals if there is an invasion in Europe. Yes, that's the other thing that, I mean, we also need to define what is fundamentals, because, even what is technicals too, because where those two words are being used by everyone who trades, often different traders or investors may mean something different with that particular word. Okay. So again, like, for example, to me, the fact that there may be a war in Europe, which is indeed, technically speaking, I'm sure that most people would agree that's a fundamental thing to happen. To me, that's not even a fundamental thing to happen, if you wish, because how do I define it? It's not something that you could predict, which is depending on the nature or the quality of the market. Like, for example, fundamentals, if you apply it to a stock, is like, how is the company doing? What is the balance sheet, of the company? So this is directly related to the company, and it kind of measures the quality of the company. But if there is a war, to me, that's an external factor, which is, of course, is a geopolitical thing. So it falls within fundamentals, if you wish, but it's an external factor which is not related to the quality of the thing you trade. So to me, I don't even call it fundamental. But again, that's just me now, right? So because again, I would probably, I'm pretty sure that most people would disagree with me in this sense. Okay, so all of those factors could act anytime. Craziness could hit the market any moment in time, and that's why we're always hedging, managing the risk, using option strategies with limited risk. We are never naked. Even if you use shares, we always use stops. So again, we are always being careful, because we know anything could happen anytime, including the craziest thing ever. I mean, think about 2020. It's like, the joke with Ukraine with 100% million percent respect, okay, for what a war is and the crazy things that happen in a war. But, that probably is going to be a small event compared to what happened with the beginning of the pandemic. Do you guys remember what happened in the market, right? Do you remember March 2020? I've seen things that year that I haven't seen in over a decade of trading, which is my experience. I started in 2008. What I saw in 2020 was huge, massive. Like 2008 was a joke. The things I saw in 2008 in the market compared to what I saw in 2020 was a complete joke. So, and now we are talking about Ukraine, like we forgot that, right? So the thing is that as a trader, anything could happen anytime. Whatever you've seen that you could call crazy may be nothing compared to other things you'll see in the future that we haven't seen yet, isn't it? So again, always that mindset, never be biased, always protect yourself, always manage the risk, always be ready for the good, always be ready for less good. And again, a mechanical approach to trading, objective, and that way you keep your emotions under control. If you are emotionally attached to the trades, you have a very strong belief about raising interest rates, Ukraine, whatever that is, and then the trade goes against you, then the problem is not that you lost some money, even if you have the risk protected. The problem is that now, because your belief was put into that and you were proven wrong, creates a sense of disappointment, which that sense of disappointment may lead to lack of self-confidence. Now there is a trade to be taken. You don't take it because whatever, lack of self-confidence. Now you miss the boat. Now you are upset. Now you trade in revenge mode, fear of missing out. All of those things happen, and everything starts because, you had an opinion about what the market was going to do. So let's not have an opinion. Let's just act based on rules, which are set by our trading plan, and we don't need to have an opinion about it. And therefore, there is no room for disappointment, emotional impact, and things like that. Okay? Cool. Very, very important and interesting conversation, the one we're having. Let's keep going so I can get back to the charts. Yeah. Christian, reading you. Yeah. Yes. Just reading you. Yes, and Mark, you call it a black swan event. Got it. I'm with you. 100%. Perfect, guys. Thank you for the questions. Okay, I love it. It's really important for me to get your feedback at all levels, and we just got into a very interesting conversation here. So thanks for that. Anyway, so positions. What do we have? Okay, so let's talk about a few positions. Okay, let's start with a funny one. Yelp. So Yelp is a trade that we entered a long time ago, and this trade has been teasing us for a long time. I think I need to load a bit more data here. Let me load some more data. So I'll do 1,000 bars, for example. So exactly. So Yelp is a trade that we entered at this moment in time, went against us all the way, tried to come back, failed, tried to come back, failed, tried to come back, failed. Then, those were the lows, then went even lower than the lows. And next thing you know, now coming back at the speed of the light, almost reached a few days ago our entry point. And actually, because we have been working on this trade and we converted this call spread into a butterfly. So we had set a break-even point here to be, let me put the mouse here to be more precise. Here we go. So we had a break-even point here located at 38. Okay, 38. So the instruction I gave, which between us, I was not expecting that market to go to 38. Talking about beliefs and opinions, right? I was not expecting this to happen at all, but we knew the break-even point is 38, and because this trade has been so disappointing, it went all the way against us. So the idea is, if it ever gets to 38, get out. And guess what? It did. It did right here. Maybe for an hour or two, the price of that stock was above 38. So I didn't catch it. Okay, I didn't catch it. I was not watching it, to be honest. This was just a trade that we put in the system for demonstration purposes during the sessions for learning, if you wish. But for the ones of you that had it live, hopefully you were watching because you had your opportunity to exit this trade at no loss. Now, since then, the market went back down. So obviously we are back into a negative territory. Okay, and this trade, do I have the midpoint? Yes. This trade is supposed to show a negative P&L of 171, which, given the fact that February 18 is around the corner, so this is gonna just drop at the speed of the light. Okay, so if you didn't exit, so I guess that's it. Okay, so that was the last opportunity to exit the trade, and that is it. Okay, so not too much more to comment on Yelp, to be honest. I mean, good experience from a point of view of converting a trade and giving the trade a second chance, reducing the risk. I guess a good exercise, but there is not too much more meat in here for me to comment. Since the trade expires on Friday and tomorrow, I would not be running a session. You won't see me until next week. So then I'm just gonna delete these rows, and we will say goodbye to Yelp. It's been good to learn from you, and that's it. Okay. Funny thing. Okay, guys, and I don't know. I guess maybe it's just me or talking about not having opinions. Maybe now I have an opinion because I observe cases of like that all the time when I trade, where you think that something's not going to happen. Next thing you know, it happens. It was really not looking like the stock would reach 38 when it was just a few days ago trading down here. But look at that, it did, right? It's kind of like, it reminds me of the Facebook iron condor we got that was looking really, really bad, and we were like, okay, those UFOs may bring the price in, and in the end it did, and it did at the end, on the last trading day, like maybe an hour or two before the close. So it happens. We have to rely on our plans. Okay, we have to rely on our plans, and the things we do, they make sense. So we just rely on it. Leonard Corporation, okay, this again, I won't comment, just speed of the light. Okay, so there was an opportunity to correct this trade here, to have the trade end up basically breaking even or small profit. If you didn't do it on that particular day, or that particular day, well, then forget about it, because this trade moved intensively against the entry point that was located all the way here. So again, another trade that expires on the 18th. And yeah, in my case, as you can see, I didn't have the opportunity to convert it. I know some of you did, so good job. And just let it be until Friday, and then it will be over. So I'll get rid of this trade as well. Qualcomm. Okay, Qualcomm is another trade that we commented on last week. Some of you already exited last week. So there was an opportunity to exit when Qualcomm came back here. Ideally, we were shooting for 192.5, which it never reached. That would be the perfect exit point. From there, it went down, then it went back up. So if you missed it then, that could have been a nice time for you to exit. I remember last week giving you specific instructions for you to exit, or at least based on the rules for you to consider exiting. But I also remember that I said, I'm not going to exit so we can watch it and you get to see what happens, because what happened with this trade is that, here we go. So you see now we are right here, 169. Okay, we are in the red territory. I mean, the good news is that the most you can lose is $30. There is no way you can lose more than $30, so it's not the end of the world. But last week, okay, you can see that even though we are trading at 169 now, just pretend for a moment that we were trading at this point. So if we were trading at this point, notice that the real-time P&L would actually be a profit. But if you were to let this trade keep moving towards February 18, which is the expiration, and the stock stayed the same, while today you would be profitable, on February 18 you would be on the red. So my comment was to watch it, and if you see that you're going to end up in the red, just get out manually, because that was exactly how it looked like last week and all these days prior to today. Okay, now since we haven't met since last week all the way to today, which is Wednesday, which is getting very close to Friday. So right here already now we are in the red territory. So if I exit this trade myself, for sure, I'm just gonna be locking in on the $30 loss. So then I'm just gonna leave it alone. But hopefully you guys acted on the rules that we discussed last week, and all of you are out of this trade and you've exited for a little bit of a profit, or if you were watching it in the prior week when it went to 180 something, so maybe you exited for $100+ of profit, something like that. My target was 192.5, which was never reached. Okay, actually I left an order in the system. This closing this iron condor with Qualcomm. Okay, this one had an activation rule. If I show you, it had an activation rule right there to exit the trade if Qualcomm reaches 192.5 or above, which was never met. That's why the order is still there, waiting as a pending order in the platform on the monitor tab. Okay, so it's up here. So that's why I never got filled. Okay, so I'll leave it alone. That order will expire on February 18th, so I'll leave it alone and that's it. But just know that there was a clear opportunity to exit from this trade. Well, meaning the trade went against us and we could exit for a profit. So that's nice. Okay, even though of course it's not nice in the sense that the trade went against us, but it's nice to be able to massage a trade to a point where you actually profit instead of lose. Okay, so that was nice. So goodbye Qualcomm, we're done with you. EOG, so that was another trade that had a massive move, massive move against us. That was a hedging trade. Okay, so the position size here was less. I believe the maximum risk of the trade was $90 or 90 something. Second, guys. Sorry about that. So this trade was not adding a significant risk at all. You can see 95 was the risk of the trade. Now notice how on the positions panel it shows a profit of 300, and that's because the 92.5 put is so far out of the money. There is no bid size that really you cannot get a bid quote for it, and therefore the P&L cannot be calculated. But remember, if you leave it alone, both of the options will expire. One will assign, one will auto exercise, and then the net P&L you'll get is negative 95. Okay, so again, another trade to be left alone, and in my case, very glad to get rid of it here on the positions panel because it was time. Okay. And then finally, now we are going to be moving into FedEx and WPM. Ahmed, how are you, my friend? Good to see you. Mark, you did not catch it. What about in the money shares? What would that mean, Mark? Because in the money is a term that applies to options contracts, but you use it with shares. So I wouldn't know what that means. Can you please let me know about that? And then Christian, you exited for a gain. Nice. Thank you so much for that. And Ahmed, hello, my friend. Good. So now FedEx and WPM. So here we have work to do. Okay, there is management to be done. Here we can see that we have a negative P&L on FedEx. Okay, which it's not a problem at all. Okay, we are not done with this trade. We have trade management to apply. The maximum risk of this trade, we're gonna review all of that in a moment. It's just a bit more than that. So. But again, we are going to act on it because it's time to act. Actually, it's time to act since a few days ago, but we're going to do it now. And with WPM, so we are making some profit. Again, remember, WPM is a double calendar. And double calendar means that we make money as volatility rises. So volatility has been rising. So we are now increasing P&L. But on top of that, there is tweaking to be added to this, which we're going to do together. So let's begin with FedEx. Okay, so with FedEx, we have an iron condor here. Okay, and I said that since a few days ago there was work to be done. So if I click on that particular day, okay, so you look at your bottom purple line and the expiration date, which is March 4. You look at the upper purple line and the expiration date, which is March 4, and you look at the statistical range from here to here, and on that day, clearly, statistics would have suggested that we would be within the purple lines, so nothing is to be done. Now, the day after, there was a massive drop, and not only there was a massive drop, on top of that, the implied volatility of the options was rising a lot. Okay, a lot. Yes, Mark, TOS shows that Yelp 35 and 30 are both in the money. Okay, so let me show you that on my console as well. Here we go. So 35 and 30. Are you talking about Yelp or you're talking about You must be talking Landmark Corporation, maybe. Yes, I think so. I think you are mentioning Landmark Corporation, I believe. Okay, because if you have 35 and 30 for Yelp, it means that you are not in the same trade I am, because I'm using 35, 43, and 50. So I guess you are referring Len. So then I guess you didn't butterfly it. That would be my guess, because we don't have 35 and 30. We have those particular three strikes: 35, 43, and 50. Okay, Mark. But in any case, to answer your question, Leonard Corporation is exactly that case. You have in the money and in the money. So what does that mean? It means that the one you are short, you're going to be assigned, and the one you are long, you're going to be auto-exercised. So in other words, you don't need to do anything. You'll be out of the trade automatically. You don't need to spend money on commissions. You don't need to execute. They will both be, taken care of as the market closes on Friday. So coming back to here, so on that day, now we had a massive drop in price for the stock, a very big increase in volatility, and therefore, if we point at the same purple line on the same March 4 date, notice now how not only some of the blue lines are surpassing the purple line, but also the red line is surpassing the purple line in a massive way, meaning that now, statistically speaking, there is a chance for the range to be broken. And this is our triggering condition for us to go ahead and tweak the condor. So how do we tweak the condor? Well, there are two cases. Case number one is when our cone surpasses the purple line. So then we need to tweak the opposite side, which in this case is going to be the call side. An iron condor is made of a put side below price and a call side above price. So guys, give me 1 second. Sorry about that. So the iron condor is made of two sides, right? The put side on the bottom part and the call side on the upper part. So when one side is being challenged, which is that case, challenge means the cone surpasses the purple line. So then we need to act on the call side above, and we need to drag it down. So I close that call side for a profit and sell new calls at a lower price for more premium. And that will reduce the risk of the trade, isn't it? Okay, now how do we do that? Okay, that was the action to be taken, okay, which we're gonna do now, okay? Because the second action to be taken is not only the cone is surpassing the line, on top of that, the price, okay, so the candlesticks themselves, okay, the candlesticks themselves are now crossing the purple line. So then what you need to do is butterfly it, okay, which is converting the condor into a butterfly. Now we are not butterflying because we haven't had that case. Okay, let me fast forward to today. So the market kept going lower. We are still having the challenge, where the cone line is surpassing the purple line, but the price is still inside the range. Okay, so we don't have that challenge where we need to butterfly. We are just tweaking. At this stage, we are tweaking. Okay, we are tweaking. And by the way, we are now entering the zone between the red and the purple line, which is where multiple UFOs are there waiting for price to come, buy orders to get filled, and bring the price back inside the purple area, which is our profit zone. So this is, it's not looking as good as if price had stayed there flat, for the whole period all the way to March 4, of course. That's a utopia though. So, but this is looking pretty standard in the sense that price moved away a bit, enter the area with the UFOs, which are likely now going to bring price where we want it to be. But in the meantime, there is statistical risk, right? So what are we going to do? Well, we're going to do what I've done here, which is I looked at this red line. Okay, so we have risk on the bottom, great. So now we look at, okay, so if the bottom is at risk, it means the top is lower, right? So our initial top was here. This is the red line. That was the original line we drew when we planned the trade. But guess what? The new red line is here now. This is where the new red line is. So I drew this red line as a reference. And then what I've done is drop to the 55-minute time frame. And when looking at the 55-minute time frame, okay, and looking at this red line, which is my new reference, okay, remember my rule is I need to have at least 2 UFOs above. So I got 1, 2, 3, and that one is number 4. So it's 2 or more. So this is number 4. And therefore I am drawing a new purple line at this level, around 265. So what does that mean? So back to loading the daily time frame, that means that 265 is right here. This is the purple line I have just drawn. Okay. And basically what I'm saying is that, okay, so the calls I got up here, okay, I am now willing to bring them down all the way to somewhere here. Okay? And which calls are those? Okay. Well, if we go back to the position panel and we look at FedEx, so the calls that we are using are 280 and 285. So the idea would be to close the 280 and the 285. Okay, so we're gonna use the midpoint. I'm gonna add 4 legs. Why 4 legs? Because I'm gonna close 2 calls and open 2 calls. So it's gonna be buy, sell, buy, sell. So the one I buy, okay, it's going to be the 280 call, which is the one we sold. 280 call, we sold it. So now 280 call, we buy it at current price, midpoint. The 285, we bought it. So 285 now we sell. And then we said the new purple line is around 265. So I'm going to sell the 265 call and buy one above, which is going to be 270. So if I click OK, I am now bringing the current risk of 395. I am bringing it down to 433. This going to be. Yeah, it could be. I guess I'm getting plenty of slippage from those units. Okay, so let me take a look at this more in depth, because I guess we are suffering a little bit of lack of liquidity on some of those strikes. Yeah, I mean 3 to 27, 3 to 25, 4 to 28, 8 to 28. It's massive amount of slippage here, and that is obviously hurting the trade very badly. So let me take a look at this. Let me open the option chain, because this normally would produce a credit. Okay, so what you would do in normal cases with FedEx, and I'm surprised that liquidity is not a bit better here, because FedEx is not too bad with liquidity. So what you would normally do is that you would take the call side, 280 and 285, and you would create a rolling order where you want everything to be March 4. Okay, so it's a rolling order for the strike selection, not for the dates. So everything is March 4. You are selling the 185 and buying the 180, very good. And now you are buying the 270 and selling the 265. Okay, so if you do that, notice that it says that you get a credit of 1. This is very surprising. I'm obviously not happy to see this, and it has to do with the level of liquidity available. Okay, so massive slippage there, which is really hurting the tweak. Normally, by doing that, you would collect a certain level of premium. Yes, Jeff, not only the premium is not too nice, it's pretty low premium, which is surprising given the fact that the VIX is 26. But on top of that, what is really hurting us is the fact that the spreads are very wide, and therefore doing this is not producing the desired result. So I want to look into the option chain a bit more in detail to see if I can spot anything that may help us to, help this trade a bit better. So I'm just going to maximize this, and I'm basically focusing on the call side around 265. And you can see that there is really no volume until we get to 255. And still the spreads are quite wide. So yeah, these options have a 3 delta, 5 delta. So no one is trading those options. So the thing is that I'm late to the party. That's basically the bottom line. So if I had done this on that day, which is the day it should have been done, okay, if I had done it on that day, okay, so what's the benefit? Well, the benefit is that, price is higher, right? So that day was what? So 211. So notice for the 265, which is currently paying anywhere between 8 and 28, if we did that in 211, so the 265 would have paid 55 to 4, 22 to 53. So still the spread is a bit in the monstrous side, but with patience and negotiation of your spread with limit order, you may have got something which is good enough. So doing the roll at a time, maybe we have brought in, I don't know, 20, 40, $60 of extra credit. I have no idea, but definitely way better than today. Today it's terrible. It's 1 cent. Okay, today you do the roll, you get 1 cent, and for you to do that, you need to pay 4 commissions. So it doesn't make sense. Okay, it doesn't make sense because of that reason. So it's a matter of the liquidity which is available. Okay, given the fact that price moved even lower and so on. So so doing this is not working well at this moment in time. I want to look at the option chain one more time to see the strikes one more time. 1 second, just in case I can see anything that opens a door for some action and share with you, because sometimes we deal with that. We deal with stocks that don't give you the contracts as liquid as you want, and maybe that stock is liquid. FedEx is not bad, but because price moves so much, okay, because price has moved so much, so next thing you know, that option is so far out of the money with tiny delta, so no one is trading it, and therefore the spreads widen. Okay, so not only you get little premium, on top of that the spreads widen. Okay, so this is real case. So I want to take a look to see if I see anything, and unfortunately I cannot do anything because I was thinking that maybe I get 2.5 strike price increments. Notice that we do 257.5, okay, but we don't have 262.5. And even with the 257.5, it's like last zero. So no open interest. So this particular strike has been released by the exchange recently, but zero open interest and zero volume means this has never been traded before. So the strike exists, but no one has traded it. So I guess that when I constructed the trade, there was only $5 of strike price increments. Now we got 2.5, but there is no one trading them. So I really cannot do anything about it. But wait, okay. So let me see. Christian, green UFO on the daily 61 may leave price for us in FedEx. Well, you read my mind, Christian. I love it. That's exactly what I was going to say. That if the price comes into this UFO like he did, and that UFO pushes prices higher, so the moment prices come higher, next thing you know, we're gonna get more premium, and now we can revisit this particular idea. Okay, at this stage, cannot do it. Okay, I cannot do it. So, and now another thing that may happen as well. Okay, and at what price should we butterfly it? We should butterfly it when, based on my rules. Okay, you can do it anytime. You could do it now if you want, but based on the rules I use, then you would do it only if the stock was to continue falling, and now the candle of the stock, not the cone, which is the red line, but the candles themselves, they are crossing the purple line. That's when you would butterfly it. Okay, so not yet. Okay, not yet. This is the time where everybody gets nervous, but the reality is that this is the time where those UFOs are likely going to push price back up. So actually, there is no reason to get nervous, even though when you see price dropping, I guess a human thing is to get nervous. But there is no reason to get nervous at this moment in time. Okay, there is no massive danger. Massive danger is when price crosses the purple line. So now you need to attack that danger with butterflying. Not yet. At this stage, we are in this soft, easygoing tweaking of the trade by bringing the call side down, which unfortunately today I cannot do. I'm late to the party, even though I guess it's a good example for you to see because sometimes the market will move very fast, and even though you do it on the right day, you may have a similar situation because the price has moved so fast that you got no premium left or very bad liquidity because those options are far, far, far out of the money now. So anyway, so patience, we're gonna wait. Now, the last thing I was going to say about this trade is that not only those green UFOs may bring the price up, which is ideal, may not bring it up. Okay, let's say the price was to just have a fight. You got plenty of sellers and you got UFOs, and for 2 or 3 days this happens. Where if for 2 or 3 days this happens, guess what's gonna happen? The implied volatility will shrink, and if the implied volatility shrinks, the red line above will look like that. So if the red line looks like that, now you would be able to draw a new line here. So instead of this line, now you would use that line. So now instead of selling the 265 calls, right? So you may end up with a purple line somewhere here. And now you may be selling the 255 calls instead of the 265, which now those calls are nearer, and therefore you're going to get so much more premium. So again, it's either the stock goes back up and you get more premium, or volatility cools down and you get more premium, or we are totally wrong and it just keeps falling like the world is ending, and then you're going to have to butterfly. Okay? So those are the situations, the choices, the actions, the pros and the cons. This is what happens. Okay? Cool. And last one for us to review is WPM. By the way, if you have any comment or question, this is your time to ask. Okay, Jeff, patience. Okay, that would be my comment for you, Jeff. I know you see it falling and it's like, oh my God, it's now working my way. It's okay. It's part of the plan, right? Part of the plan is to have this area between the red and the purple line, which is where additional UFOs are, potentially helping us to bring price where we want it to be. So patience. And if wrong, then we'll butterfly, which is damage control mode. Okay. Cool. Now WPM. Okay, so WPM is the double calendar that we have in the system. So that stock went down a bit, up a bit. So it's in the middle of the range. It doesn't really matter to be honest in this particular case, because we are playing volatility much more than the stock or the range. But at the same time, it is important for us to go back and revisit what's happening with this trade, because if you recall, we started this trade using March 11, and February 18, but then in the last session that we did, that bottom February 18 was moved to February 25, okay? And that's the position we currently have, or if I graph it, it looks like that. Okay, it looks like that. We're making some money, $22 of profit. Okay, great. Now, what to do now? Well, take a look. If we look at the option chain for WPM, and I look at February 25, February 18, okay, and even March 4, I'm going to look at 3 expiration dates, and I look at the 2 strikes we care about, which the 2 strikes we care about in this particular case are 44 and 39. So I'm just going to remove these and just focus on 44 and 39. Okay, so that's the only thing I see. Okay, 44 and 39. So we concluded the other day that when it comes to on the top, February 18 on the top, okay, we concluded that the 39 put had fake Greeks. Why? Because theta is 12. So you're supposed to make $12 per day, 12 cents, where the bid and the ask is 3, meaning that the most you can make is 7. So, and we still got 2 days and a half to expiration. So 12 times 2 days and a half is way more than 7, which means it's not possible. So we conclude the Greeks are distorted. And why are they distorted? Because we are too close to expiration. So it's time to roll, which we did for the put. Now, what about the call? Okay, well, for the call, we are dealing with maximum 15 cents, where theta is 17. So same story. You probably remember last week they were not distorted yet, but this week the Greeks are distorted for that particular option. So in other words, instead of keeping it the way it is, you can now close it and sell February 25 and collect somewhere between 35 to 53. So we're going to do that right now. And what would happen if we do that? So if you do that with WPM and we take the 44 call that expires in February 18 and we roll it to 25, okay, so we buy it back and we sell it 25, that's going to bring in new $31 of credit, which I'm going to do right now because it's the right thing to do, and then I'm going to simulate it so you get to understand the impact of this. So let's place the order. Okay, so the order is in the system. Okay, I just got filled. I got filled at 32. Thank you very much. Again, this is simulated, but it's fine. So I just added additional 32 cents of credit for the call. So how do I simulate that? Well, I'm going to go back to top, back to the risk profile. And now notice that what happens is that, well, first of all, let me do this. Actually, I'm going to do it like that. I'm going to use the compare spread functionality. I think it's going to be more eye-opener for you guys. So this is the current trade we have. Okay, the current trade we have, worst case, okay, if the world is ending, we're going to lose $108. This is the per contract. Okay, 108 is the maximum risk per contract. Okay. Now, what if we now do what we just did, which is take the 44 call on February 18 and we move it to February 25? Okay, and by doing that, okay, we add new 32 cents. Okay, we add new 32 cents. So how can we simulate that? Okay, well, this February 18 call was bought back at 12 cents. So it was sold at 22. We bought it back at 12 cents. Did I say right? Yeah, 12 cents. So basically we made 10 cents on that original call, and then we sold a new call at 44. Okay, we sold a new call at 44. Correct? So by doing that, okay, that's how we end up with 32 cents of credit. Is that making sense? So we left 12 cents out of the 22. We left that, okay, but this still made us 10, correct? This made us 10. And now we collected new 44. So in other words, we don't know how much we're going to pay when we close it, but the net effect is that this 44 call has produced for us the equivalent of 54 cents. Why? Because we collected 44, but thanks to having sold the February 18 that we sold at 22 and bought it back at 12, so we collected 10 cents. So again, in other words, it's like the premium you collected today is increased by the profit from the prior trade, which was 10 cents. So that is 54. So in other words, if I click OK, now you're going to see the resulting trade in orange color that we have, which is right here. So what is the most I can lose now? Well, the most I can lose now is 76. That's the most you can lose, okay? Given the new P&L of the trade, okay? So that's the most you can lose, 76, okay? And of course, the trade now has a range where you profit, which is the green area, but also the trade is still sensitive to volatility, where if volatility rises, so now the green area becomes way greater, way wider, okay? So that's what we are playing. And by the way, we're going to keep exploring this, okay, into following weeks, because then February 25 will help us to sell March 4, etc., etc. And by the way, maybe March 4 is to be sold already. Let's take a look at the option chain one more time. So option chain, why is it that March 4 is not? Updating. Okay, not sure what happened there. So anyway, so here's March 4. So the call, we're gonna leave it alone because we just sold it. But what about the put? Well, the put has up to 22 cents of premium, and theta is 2 cents. So what does that mean? We got 9 days to expiration. Okay, 9 days to expiration. 9 times 2, that's 18. So 18 is less than 22. So the Greeks are not distorted yet. Sorry, guys. I think I just clicked in a place here and I just got a bit confused with what I have on the screen. Okay, now I see it all correct. So yeah, so in other words, the Greeks for the puts are not distorted yet. 2 times 9 equal 18, which is less than 22. So it's still okay to leave it alone for a few more days until the Greeks are distorted. Okay, and then we'll do the same thing. We'll sell then the 39 put that would pay you 33 instead of 22. But there's no time to do it yet. There is still rate of time decay to be accumulated from that put that we sold, and therefore no time to do it yet. We just leave it alone for a little longer. Okay. So with that said, we just reached the top of the hour. It was important conversations to have here, and of course with the double calendar, I guess it took a bit more time than other type of trades. So I'm just gonna right click, copy position to the clipboard, get my positions, paste it here. Okay, so this is now the new tweak that we have, and ready to continue tweaking until we get to the expiration of this trade. And remember, the expiration is just after earnings, so we expect volatility to increase at that time, so we'll talk about what to do. But again, looking forward to it, because that would probably translate in a greater profit than what we have now as volatility rises and time passes. So we are ready to take advantage of that. So I'll close this now, and like to ask you for the last time, how did it go today? Any question? How is it going? Anyone is confused? How is it? Oh, Christian, how did I draw the purple line around 255? I didn't draw it. Oh, I know what you mean. FedEx. You are talking about this purple line, correct? Okay, talking about this purple line, I believe. If you are talking about this purple line, that purple line was the line where we entered. So the stock was trading here. That thin purple line represents the entry. Okay, that's what it means. Got you. Perfect. I got you now. Represents the entry. Good. Joe, a lot of great info on top. Yeah, thank you so much. Thank you so much. Perfect, my friends. It's always a pleasure. I love to spend time with you guys, get together and do these things. Keep up the good work as always. Keep up the practice. Any question, shoot us messages, website, email, whatever it is. The team is here for you guys. I am myself 100% committed to you as well, guys. So yeah, just use the resources and go for it, guys. Trading is such a beautiful thing, as we know. So let's do it right. Take care. See you soon. Don't miss Josip at the end of the week, okay? Bye-bye. Take care.